When you invest a portion of your paycheck into a standard index fund, like the S&P 500, you are buying into the 500 largest publicly traded companies in the United States. The goal is to distribute your wealth across hundreds of different industries, ensuring your portfolio doesn't rely on the success of any single sector. The internal structure of the market has changed. Today, the performance of the entire index is dictated by 7 tech companies: Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, and Tesla. This data shows the reality of modern diversification. Roughly 40 cents of every dollar you invest into these broad funds is being funneled into this small cluster of tech giants. Within that group, NVIDIA is absorbing capital at a rate rarely seen in market history. By itself, it now receives nearly 8% of every dollar entering the broader S&P 500. Retirement accounts are increasingly tied to the performance of these specific companies. This shift means that most passive investors are now making a concentrated bet on artificial intelligence, moving away from the broad economic stability they originally paid for. NVIDIA's market capitalization recently crossed $2 trillion. To visualize that scale, this single chip designer is now worth more than the entire annual economic output of Canada or Italy. This growth is creating vast wealth inside the company. Internal data suggests that 3 out of 4 workers at NVIDIA are now millionaires, with at least a third of their employees holding a net worth of more than $20 million. When one stock moves the entire index, we have to examine the underlying math. We need to determine if these valuations represent a sustainable leap in productivity or a systemic imbalance. The market is betting that AI will generate enough wealth to justify these prices. This raises a central question. Is this value based on real economic output, or are we looking at a cycle that mirrors the frenzy of the year 2000? To understand how the market justifies these current prices, we need to look back at the late 1990s. During the dot-com boom, investors threw billions of dollars at internet startups that lacked viable business models or actual profits. While many of those startups failed, the companies that built the physical backbone of the internet made billions. Cisco Systems manufactured the hardware required to move web traffic, making them an essential provider for the entire era. NVIDIA occupies a similar position today. They design graphics processing units, or GPUs, specialized chips that provide the computing power required to train every major artificial intelligence model. If a company wants to operate in the AI space, they must buy from NVIDIA first. Because NVIDIA sells tangible, high-demand hardware, Wall Street views their revenue as more reliable than the speculative software of the past. This physical output makes the company's valuation appear grounded in reality, even at these historic levels. However, tracing where the money for those chips actually comes from reveals a structural flaw.
The demand isn't coming from millions of independent customers, but from a system of circular financing within the tech industry itself. The cycle begins when NVIDIA invests billions into startups like OpenAI. Those startups use that funding to buy massive cloud computing contracts from other tech giants. Finally, those cloud providers use that exact revenue to buy more GPUs from NVIDIA, completing the loop. This feedback loop makes every company involved appear to be rapidly growing. On paper, revenues are rising across the board, but the capital is simply being recycled within the same corporate network. This structure is fragile. It suggests that much of the growth propping up the stock market relies on tech giants trading the same capital back and forth, rather than new wealth entering the system from the outside world.
To maintain this loop, these companies are committing hundreds of billions to capital expenditures, or CapEx, the massive spending required to build the data centers that house these chips. To justify these investment levels, the AI industry must eventually generate $2 trillion in real consumer revenue every single year. That figure is staggering. If you add up the current combined revenue of Apple, Amazon, Microsoft, Meta, and Google, they still fall short of that $2 trillion requirement. There is a disconnect between the billions being spent on hardware and the actual profits generated by AI software. Right now, tools like AI chatbots represent only a tiny fraction of the money being spent to build them. The stock market has already priced in a level of profitability that mathematically does not exist yet. This creates a trap for investors who assume that current spending will automatically translate into future returns. Identifying this gap doesn't mean the market will correct tomorrow. Bubbles are often driven by sentiment rather than immediate logic. Historical data shows that markets can remain irrational longer than individuals can remain solvent. This makes it dangerous to bet against the current trend, as the cycle of circular financing could persist for years. When the dot-com bubble popped, the speculative money evaporated, but the internet itself survived. It eventually matured and rebuilt the global economy, proving the technology was real, even if the early stock prices were not. We are likely seeing a repeat of that pattern. Even if the circular financing loop breaks and AI stocks face a major correction, the technology is real. It will continue to advance and eventually restructure the global economy. This creates a dilemma for the everyday investor. AI is clearly the future, but the current price for a seat at the table is being held up by an internal accounting loop. Relying on a single tech stock for your entire retirement plan carries immense risk. If the math of the $2 trillion revenue requirement doesn't eventually balance out, the correction on Wall Street will be severe. Wealth in this era requires navigating the space between the reality of AI's future and the mathematical illusion of the price we are paying for it today.